Hi, I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors. Great to be with you today. Just last week, I was at a workshop on IRA and retirement plan distributions and strategies with one of the leading experts in the country, Ed Slott. He's commonly on PBS, and learned quite a bit. But there's 3 big IRA mistakes that I wanted to share with you today because they're critically important for you and your success. So let's jump in. Number 1 is forgetting that there is a substantial mortgage or liability on all of your retirement plan assets in your IRAs. What do I mean by that? Remember, if it's a pre-tax account where you put in those pre-tax contributions and the growth over time, there is a tax liability that's due when the money comes out of the plan or out of the IRA. So in this example, if you have $1 million IRA, let's say that you want to draw income out of it, well, there's a tax liability associated with it. And here it's like, let's say it's 40%. That means there's only $600,000 that's left over for you to utilize for spending to take care of your family and take care of your lifestyle and retirement. So don't forget about that liability, the tax liability. So what are some planning strategies to mitigate some of that? First is Roth IRA or Roth 401k contributions. So then you remember Roth IRAs go tax-free, and if you meet a couple of requirements, the distributions are also tax-free. Secondly, if you say, hey, I can't contribute to a Roth, I make too much money, there are other strategies called a backdoor Roth. That's another way of getting after-tax dollars into a Roth IRA. And then third is Roth conversions. Remember, tax reform, we can't reverse a Roth conversion anymore, but still with tax rates on the lower side, historically speaking, this year and in the coming years, this might be a great opportunity to be looking at converting some of your traditional IRA money into Roth accounts to be able to maximize those tax savings over the long run. Number 2, qualified charitable distributions, QCDs. We do these a lot of times with clients, but I want to talk today about how to make sure it's reported correctly on your tax return so you get the tax benefit. Here in an example, let's say you have $1 million IRA and you have a $40,000 required minimum distribution. What the QCD does is it allows you to take, let's say, $15,000 of that $40,000 and have it paid straight to a charity. The IRS allows you on that $15,000 paid to charity, it's not taxable to you. Only the remaining portion in our example, the $25,000 is. But on the 1099-R that you get from the custodian, it doesn't differentiate between those. So how do you make sure you get your tax benefit? That brings me to the 1040. So either you or your CPA have to code this correctly. Go down there to line 15A, 15B on the 1040. Here I had the example. So the RMD, remember, is 40,000. You carved out 15 to the charity. And so on 15A, it's 40,000 because that was the distribution amount. But then on the taxable amount in 15B, you're going to have them right in there 25,000. And over in the margin, we recommend that you put in QCD, qualified charitable distribution, to make sure you don't pay the tax on that portion. Last but not least is beneficiaries. I can't stress this enough. People tend to forget how important these are because it trumps what your will says, your beneficiary designations do. And then when you get to retirement accounts, there's a lot of different rules and different options when it comes to naming beneficiaries. So the first mistake we sometimes see is where people will name their spouse along with others, maybe other children. The problem with that is that the spouse, then it's limiting their options or their choices when it comes to maybe they can do a spousal roller, but if there's other named beneficiaries with them, it might limit them to some degree. Maybe a better strategy might be to split it into 2 different IRAs. Second mistake we see is naming trust as beneficiaries. You have to be super careful here. If you're not, and the trust isn't set up properly, it could trigger all the taxes either immediately or within 5 years because it's not a living, breathing human being that can do a stretch or an inherited IRA. So when naming a trust, 2 things you need to be thinking about, and 2 ways to mitigate that problem is make sure it's a see-through trust, like what they also call a conduit trust, where there's a properly named beneficiary within the trust to allow to use that life expectancy of that beneficiary. And then secondly, 1 trust, 1 life expectancy. So here, if I have an IRA, or Katie and I have an IRA, we might name Will and Kate 50-50, but we're going to name their IRA trust 50-50 because then they each can use their own life expectancy and really stretch out the taxes over many decades and over their life expectancy and continue to have the compounded growth. Huge advantage by allowing the inherited IRA. So be careful on naming trust with your beneficiaries. All right. Last but not least, dominant strategy. Number one, as you can probably tell here, get your expert team in place and make sure they have great knowledge and networks when it comes to retirement plan distributions and naming beneficiaries and tax mitigation strategies. Number two, speaking of tax mitigation, yes, it's important to mitigate taxes now, but also be thinking out into the future over the entirety of your lifespan, because you may be saving taxes now, but what is that set up for in the future? And then last but not least, beneficiary reviews. If you're clients of ours, we're going to be reviewing this, having this on the agenda when you come in, making sure that things are set up properly and that you avoid some of those common mistakes we just talked about. If we can be of any help, give you a second opinion on your situation, give us a call. We'll set that up. And if you're a client of ours, we'll be seeing you soon and talking about these things right here.